National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
And on today's show, Section 79 plans with special guest Ken Davis, CPA.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, and I did hear in the introduction that he's a CPA, but wait, there's more. Ken Davis, CLU, ChFC, CFP, and CPA. Ken, welcome to the show.
Hello, Stephen. Good to be back.
Welcome back. Hey, listen, if you've missed any of Ken's shows, go back in our archives. We did an end of the year 2011, 5 days, awesome. And we also did a charitable giving, which, by the way, we're going to re-release because we took, actually, Ken's cool idea was you can actually build out your practice using charitable giving. I know, surprise to me. And we're going to re-release on a landing page with all kinds of giveaways that we did in that show because we think this is a high thing. And by the way, it's not just the end of the year. We did it for Christmas. Charitable giving, Christmas kind of goes together. But today we're off the rails today. I thought we actually can, honestly, Section 79 plans. I have not seen a lot of this lately, but I mean, it's going to be making a major comeback for employer-generated benefits. I mean, really,
Absolutely.
When you think about it.
Yeah, and you know, it takes a while for ideas to percolate through, and there were some changes. I think they're 2006 where we established some safe harbor rules with the Internal Revenue Service. It's made this thing a whole lot more attractive to go ahead and do and safe to do so.
Now, I noticed out in the web years back, and it was only about 2-3 years back, they were attaching Section 79 with bad boy 419 plans, abused 412I plans. So when I look at this is not, we're not talking about any of those. This is really down the middle code.
Yeah, this is pretty straightforward, and I know some TPAs that administer these plans that have had their plans scrutinized. One in particular has 1,000 plans in place and 8,000 employees, and there's been, I don't know, 20 or 30 audits, and they've always come out clean with what they call no change letters, is what I've been told. So,
well, I love the fact that we're using, I love it. I always try to title something, you know, something really cool for the show, but really, this time I have to actually title it by the IRS code, Section 79.
Yeah.
Give me a little introduction, and everyone of our viewers, because how much impact is this going to have on your practice if you can play in the employer-driven benefit area?
Well, I don't know if our agents like the idea of a, you know, the minimum contribution of these plans is typically $25,000 a year in premium, with 50 to 70% of it target premium. And a lot of times it's $50,000 or $100,000 a year, and I know of one particular case with one TPA where, get this, Steve, this is true story, $1 million in premium per year with a big doctor group. Huge, just huge stuff. So these are big tickets. A
little side note, physicians are really a target audience. We're going to get into that later, but that's a key one. Well, let's talk a little bit about the code itself. Now, every time I see a code and I see tax deductions and giveaways by the United States government, I panic just because it's not in their benevolent nature to keep this kind of a code online. Usually I thought they'd kill it, right? Like 419 AF5 and AF6 plans. But when I'm looking at Section 79, this is a pretty good deal and the government's okay with it.
Yeah, you know what I like about it is it's not way out there. It's not beyond the edge of the envelope kinds of stuff. It's within a reasonable boundaries, and so it's not, when you look at it, it doesn't look too attractive as a target. In fact, I was talking about this with a friend the other day. So, well, yeah, just look at qualified plans. They're a bigger target than this has, and in fact, the tax laws as it relates to qualified plans changes constantly. They're always coming after it, and the changes to the Section 79 plans have been relatively minor and large periods of time in between. So and maybe if it starts to get more popular, we may see more activity there, but it's not an outrageous code section. It's incremental, not revolutionary.
Well, what do you think is the major premise of the IRS with this kind of deduction and using life insurance to pull this off? Well, what's the thinking behind it?
Well, you know, one of the nice things that I like about life insurance, as long as it's not abused.
Whoa. CPA likes life insurance? You heard it first on the Business Insurance Zone. Okay.
Well, you know, Congress generally will put tax benefits in that benefit society. Okay, where they get really angry is that where there's really no benefit to society. It doesn't stimulate business. It doesn't help charities, whatever. Then they get real excited about stuff like that. When there's actually a social good in it, and life insurance is a social good. If somebody passes away and they leave death benefits to a family, or to a business partner, or somebody to pay taxes, those are all good things. Those are social good. And so that's why life insurance and all the benefits that we have with life insurance has survived so well over the years, is because there is a real good reason, and there's economic reasons. And what we're going to find out is that the life insurance bought through Section 79 is going to, most people think it's all term insurance, but you can actually buy permanent cash value life insurance through it. And you get all the tax benefits that you get from life insurance, plus typically a 30 to 40% upfront deduction. So it's kind of like a Roth IRA on steroids, where Roths get tax deferral, tax-free distributions, and with life insurance, tax-free death benefit. But you throw an extra 30 to 40% deduction up front, you don't get that with a Roth. Okay, and we're going to be talking about regular qualified plans and Section 79, but 30 to 40% is not an outrageous deduction, so it's not a big target. It's enough to spike up the internal rates of return and the economics of the deal, help overcome some of the costs of the insurance inside the life policy, and be a good economic deal, as well as life insurance benefits and possibly living benefits.
Now, the company, does it have to be a certain entity as far as an organization? Does it have to be an S, a C, an LLC? What the partnership? Again, what am I doing here?
Yeah, every time you do any sort of a planning concept like this, you're going to have pluses and minuses, and it's good that you bring it up front. Generally, to use Section 79, it only applies to C corporations or LLC corporations that are taxed as C corporations. However, most attorneys and CPAs can work with a client to advise them to set up an additional C entity. And now we're getting a little technical, but basically you have control groups and affiliated corporations where if one is giving a benefit, then they're all required to give it. Well, normally that's used against the taxpayer, but in this case, we might set up a C corporation that has it has to be a legitimate business purpose, such as a management company, a finance company, a leasing company, something like that. So the owner might have 2, 3, 4 different entities, none of which are C corps, and they can set up a new C corp that might be a management company that is leased out their services to all these others and gets revenue from that. So it takes a little bit of effort, and you're going to have an attorney and an accountant involved, most likely, but that works. Then once you have the C, they have common ownership in all these entities. So when you do it for the C corp, everybody else has to be covered. So the owner, the Section 79 is really being offered to help supplement the owners and key employees, and we'll explain why that works later on, even though there's non-discrimination testing. And so they have to be an employee of a company, and now they're going to be the employee of the C corp, and that's where they're going to get their W-2 income that makes them eligible for this program.
Well, it sounds like a great setup, especially if you are a C corp or an LLC that's taxed like a C corp, or it may be, like you said, create some kind of umbrella or parent company, something like that that touches all these other subsidiaries, maybe. Well,
and the fact of the matter is, one of the things that we learned when we do advising for clients is setting up separate entities has legitimate reasons. From a liability standpoint, wouldn't necessarily be a bad idea to have a separate finance or leasing company. If you look at your major conglomerates, that's why there's just dozens of companies. They're each set up for specific purposes. They can be sold off or limit liability, whatever. So that isn't such a bad thing anyway. It may actually lead to the client putting a structure in place that has additional value, and it has to have a legitimate business reason. I have to emphasize that.
Now, in group, when I hear the word group life, generally, the moment I hear that using Section 79, the first thing comes to my mind is some kind of simplified underwriting.
Exactly.
So it's not. We're not going to be doing normal protocols or requirements. It's going to be more looked upon a group. They're going to look at the size of the group. Does it have to be a minimum or a maximum to play in 79?
Well, what confuses the issue is we have kind of two separate rules depending upon the size of the company. Nine eligible employees, not necessarily participants. They don't have to participate, but 9 eligible employees or less will have non-med underwriting, okay, meaning no blood and urine and no attending physician statements, simply a questionnaire. Now the questionnaire, the insurance companies aren't
got normal knockout questions.
Yeah, it's knockout questions. And basically, if you're a Schedule B as in boy or better, generally you're going to qualify for this questionnaire. If you're less than that, you're going to be knocked out. So if the owner is doing this to a large extent for themselves and they're going to be less than a B, it's not going to work. But if they're B or better, it will work. And they're all issued at standard for when you have 9 or fewer. And then there's also going to be some additional what do you call that? Where you pay so much for so many years, and then it stops.
Kind of a paid up, a limited policy pay.
Yeah, you have just an initial fee that's charged for a few years because there's additional risk for the lack of specific underwriting. Now, when you get into 10 or more, then you have full underwriting. Okay. And it's interesting, the first rule is why there's a whole lot of players that aren't in this.
Now, see, I would have thought that would have been totally opposite. The more people I have, law of large numbers, underwriting should be more benevolent, should be more simplified. But no, it's actually, to me, it sounds counterintuitive.
It's not well, maybe it's because the IRS understands it, it's counterintuitive. They don't want you to abuse the rules, so they're going to require that it's simplified issue for the smaller groups, so the employees are included. I'm not sure why the law was set up the way it was, and it does seem counterintuitive, but the fact of the matter is that's the way it is. And most insurance companies won't take the adverse selection process of 9 or fewer employees, especially if it's 1 or 2. They set up certain guidelines, like one of the 2 major insurance companies requires it can't be more than $100,000 a year in premium. Okay.
So got a cap.
Got a cap for 9 or less. If it's over, typically it's going to be $200,000 or more is the cap, or in that particular case, 10 times their salary. And then there's other little rules that the IRS requires in terms of banding of who's offered what amounts and that kind of thing. But generally, there's only a couple of major players in this because most of them won't do the guaranteed issue for 9 or fewer.
Well, I guess I'm thinking when I have a big corporation, there's really, why even use the term group life if I have to go full medical underwriting for everybody, right?
Well, that's right.
Philosophically. But there's a lot of small businesses that are 9 or less.
Yeah.
That can really fit into the mode of Section 79. So, I do want to do, I'm happy to do full underwriting. A lot of people will benefit from it, especially if you're under 50, you're going to benefit big time.
Yep.
So I want to be able to always do it. When I'm looking at 9 people, that's a nice boilerplate, and I think there's thousands of little businesses that have 9 or less. And by the way, that includes the execs, right?
Yep.
Unbelievable. When we come back, we're going to talk more about this because we want to know how to find business owners that are going to qualify for Section 79. You're listening to The Business Insurance Zone, the talk show that focuses on insurance in your practice. You can write me at thebiz at brokersalliance.com or call me 1-800-290-7226. Ken and I will be right back after a word from our sponsor, Brokers Alliance, the nationwide distributor of insurance products and services. We'll be right back.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high-definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, financial color commentator, and I think interviewer extraordinaire. Oh, yeah, okay, you don't like to leave it. Well,
at least somebody does.
Remember, before moving forward with any of the strategies we talk on this show, make sure you talk to your CPA, especially this show, attorneys, broker-dealer compliance office before moving forward. And remember, You can call us and for any of your quotes on life insurance, DI, annuities, LTC, group pension plans at 1-800-290-7226, 147. Hey, it's not what I know, it's who I know, and that's why I have Ken Davis, CLU, ChFC, CFP, and CPA on the show. And I just want to say welcome to Alphabet Soup Land. Your name, you got Ken Davis. You know, you got these guys with short names, Ken Davis, and then you make it elongated because you're so credentialed. Yeah. Unbelievable. Well, Ken, I want to talk about, we've been talking at the front end, we're doing our introduction to Section 79 plans. This is a huge opportunity for our producers to really get in front of small businesses and really make not only an impact on their businesses, but these are huge, huge tax advantages here. Not only because we're using life insurance, which in our land is already tax advantaged, but now the IRS and their benevolency, kind of a shock in there. IRS code, Section 79, I want to live there on small entity groups, and it has 9 or less, if I understood our first segment, 9 or less, will actually get some sort of simplified.
I use the term guarantee, but it really is simplified, and like I said, it's table B or better. The questionnaires are designed to knock out less.
Well, Ken, I forgive your inaccuracy there because you're not quite converted totally over. You're still CPA, and you do believe in life insurance, and you're one of the few guys I've ever met. But yes, there's a difference between simplified and guaranteed. Yes. Well, Ken, let's talk a little bit about it here. I want to know some of the boilerplate talking points of why, if I'm going to get in front of an employer, why are this such a thrill? I mean, there's a lot of little points here to be had. Why don't you walk us through the kind of outline?
Well, I think there's some obvious and then less obvious things. And the fact of the matter is, I think owners and key employees, I hear it all the time, I'm sure you do and our producers do, that they're complaining about their 401k limits. Okay, basically, it's greatly simplified. If their employees are only putting in an average of 4% of compensation, even though they're matching up to 6%, they're only going to be able to put 6% of their compensation in. And for a lot of these guys, that's just simply not enough. And they're spending a whole lot of money in matching funds for their employees. They're paying for administrative costs. 401ks really are not terribly popular by owners. They do it mostly to benefit their employees, and it really is kind of hard to chew on the fact that this money's going out, and the deduction doesn't nearly compensate them for the cost of these things. So you got frustrated owners who want to put more away tax benefited, and then you have key employees. One of the guys I'm working with has 85 employees, and one of his key employees, head of their sales department, wanted to put 40 grand away into something, and he was getting checks back at the end of the year because they hit their limits. So a lot of frustration out there. The less obvious thing, I think, is, you know, after the markets of the 2000s, the lost decade, a whole lot of people are saying, you know, gosh, I was 45, now I'm 55. I can't take the risk in the market I once did. I need to know I'm actually going to build something in the next 10 years, and having an index product in a 79 plan, tax benefited, you don't have to go for the high returns. If you get some nice tax savings, your net after tax becomes rather attractive and done safely.
And I can't put life insurance in a 401k.
Well, actually you can, but it's in the profit sharing plan, and that becomes a whole different issue. Well, but generally this works a whole lot better.
If the employer is already uptight about the 401k admin issues and everything else, I don't want to put that on top of it. Well, that's true, absolutely. That just exacerbates his...
no, it's not a good solution.
Well, when I think about it though, that's a great idea because, okay, I don't have limitations. That helps.
Right.
And that's a plus. And another thing you said was, it's not fully deductible, but there's a good chunk that is.
Well, I'd like to look at it this way. From a sales perspective, it's one of the easiest sales in the world. And I'll tell you why. You find some frustration or somebody to talk to and say, Mr. Business Owner, if I could show you how to put pretty much an unlimited contribution to a Roth type 401k, but in addition, the law has changed to add an additional 30 to 40% deduction up front that you don't normally get with a Roth, how much would you put away each year? That's the whole thing right there. And what would you say? I'm going, gosh, if I want to put a lot of money away and I'm getting a Roth type benefit and an extra 30 to 40%, why wouldn't I want to do that? Well, and generally they're going to respond that way, and they say, well, how does this work? And so, well, you know what, before I go into all this detail and technical stuff and bore you silly, all I need for you to do is to give me census data on your employees. And what I'll do is actually take your specific data, we'll run it through some professional advisors for free.
Now, is this a lot of deep data collection, or is it pretty basic?
No, it's name, ages, how much they make, stuff like that. It's just a grid of, I don't know, 5, 6 columns, something like that.
Now, we have the census report. If you
Sure.
just want to call us, 1-800-290-7226, extension 147, we'll shoot it out to you. As well as, you know, we have several carriers that we're playing with, but really 2 or 3, we won't get into that right now at this time. But we're using a lot of ideas. It's kind of combining the IRS's benevolency through Section 79 and the life insurance perks that already are there on tax issues.
Right. It's like you have your life insurance with all the benefits, the tax-free buildup or tax-deferred buildup, tax-free withdrawals, tax-deferred loans, and ultimately tax-free death benefit. You get all the benefits you normally get with life insurance. However, you tack on through 79 this entry gate that gives you a 30 to 40% deduction, and you've just kind of supercharged the whole life insurance thing.
I'm not trying to be oversimplistic about it because we are a life insurance vendor, okay?
Yeah.
We're the largest in the United States. But I don't understand why somebody that wants to put in, as you said, over the limits or much more money in, why this would not be the plan for 2012. I just don't see why this would not be it.
Well, I think it's a really important plan, and it can be argued. Different people will take different viewpoints on how it compares to qualified plans. We'll talk about that a little bit later. But you know, there is safe investing. Index does give you some of the upside of traditional investing, and you get all the tax benefits, but there are costs associated with it.
Now, wait a minute now, just to make sure I heard you say, I've heard you used index twice now. You've never used the other formats. So you must have a reason. And by the way, remember, this is unique because Ken being a CFP and a CPA, I find his position is very unique in our community because when he starts picking and choosing, there are really deep reasons for this. And no, I'm just saying, you know, just you have reasons. Indexes, you've used index twice now on the show today.
Yeah, the whole program really revolves around an index universal life, and that's what makes it work. The variable, because there's certain formulas as to how much of the contribution is deductible, and variable life just doesn't work. I
So
mean,
it wouldn't qualify anyway.
no, it just doesn't work. The deductions are not sufficient to make the thing attractive, so you just don't go there.
Off the table.
And one of the 2 major carriers has a combination of a fixed interest type product that eventually leads into indexing after the 5th year, and the other one has a kind of a unique indexing strategy that does that right from the start. But when you're running the numbers and processing it through, and the third-party administration companies are doing their tax calculations, the indexing strategy works, and the others really aren't as attractive or don't work at all.
I've noticed, this is a kind of a heads up too. I mean, not only is Ken saying this, but I noticed that the TPAs are kind of there on this.
Oh, yeah.
They've looked at the different chassis and they go, oh yes, indexed UL all the way.
Yeah, it's actually the third-party administrators that really have guided me and advised me in this area. And you know, they're the experts in this area, and I've learned a whole lot by interviewing them and spending time with them. So yeah, definitely the indexing is really the way to go. And think about it, it's safe. You know, your gross crediting rate will never be less than 0. Yes, there are expenses on the years where there's 0, so cash values can decline. But it's not like a traditional securities type situation where you could take a huge market loss. And so this is safe, and you know, most of them are crediting 13.5% in this arena. So
I've noticed that a couple of our carrier, well, one for sure that comes to my mind.
Cap rates, it is.
Yeah, cap rates. One comes to my mind where they actually will give you a point during a 5-year point-to-point. They'll give you a percent, which can mitigate some of those expenses. So this is really a protected chassis and has the potential for some really nice growth.
Yeah, so you've got, the way I look at it is we get a formula. We've got gross returns, then we have investment management fees and expenses and product fees and expenses. We come up with that number, and then we take taxes off, and we come up with our net number. Whether it's a regular qualified plan or a Roth type qualified plan, the net returns when it's all said and done in retirement come very similar if you have constant tax rates. In a rising tax rate environment, here's another reason why this works. In a rising tax rate environment, the Roth actually looks better. So life insurance is a similar concept, not exactly the same, in some ways better, but Roth does better in rising tax rates because you're not getting a deduction at a low rate and then being taxed at a high rate. You don't get your deduction in the low rate environment, and then you get the tax relief in the high tax rate environment. So Roth as a concept, as a strategist right now, I would prefer that over traditional. And life insurance pretty much does that. And then you tack that extra 30% on the front end as a tax deduction. It's pretty cool.
Well, I like that feature that we have the indexing product, which is very popular anyways as a standalone product. It's really popular. And I see so many carriers bringing new IUL contracts to the table. But there's only a handful, I mean, I can count them on basically one hand, that are really playing in the Section 79 market and offering an IUL product.
Right.
So it's very remote, but I have to say, this is a huge, I would say for your business, a huge opportunity to promote you as a person that really knows this. And we're going to have all kinds of giveaways on this when it's all said and done. All the turnkey, the census gathering, examples of the illustrations, the tax deductions. We'll try to put this all together for you so that you can really have a great idea. This is something that can open the doors, especially to the basic gatekeeper when they say they're always looking, I can't find, remember we did the end of the year show and everybody kept calling us, hey Steve, I need more deductions. They're always talking about more deductions. And here's an excellent place to play. And before we take off, because I'm looking at tomorrow's show and the shows, and these are going to be huge shows to invite you and to actually introduce you into Section 79. We can watch this show today and all our shows on HD 1080p right on our own homepage. Just click on the red button. It's right there, www.brokersalliance.com, and on all our social networks, YouTube, Vimeo, Facebook, LinkedIn, and Twitter. This is Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. The Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.